So hello guys, this is your teacher Haris Bhatt and you are seeing my YouTube channel Learn Accounting with Sir Haris. Today we are going to solve a complex question of international accounting standards for A2 accounting. So this topic is basically ignored by most of the teachers, though it is the most important topic. I'm not talking about theoretical point of I'm not talking about theoretical point of view. I'm talking about numerical point of view. This topic is evenly you may say important for your exams regarding your numerical approach. So we are having so many questions coming in the exams of international accounting standards, which are supposed to be required to be solved numerically. So let's see. IS International Accounting Standard is the topic. A2 accounting is our course. So Yuan was the external auditor of Z Limited. Let's see in which year this question has come. February, March 1732. So February, March 1732, we have this question. So Yuan was the external auditor of Z Limited. Explain the difference between the role of an external auditor and the role of an internal auditor of a limited company. I have my lecture on auditing, which is available on the YouTube channel. You can go through that lecture because it is completely a theoretical part of the syllabus. But regarding this particular A part, I'm going to give you the answer for that. So external auditor is basically a person who is being hired by the shareholders, who gives an independent opinion that the financial statements are prepared correctly and they are showing a true and fair view of the business. And there is no material misstatement. There is no material misstatement found in the financial statements. If there is a material misstatement found in the financial statement, external auditor used to give a qualified report. Qualified report means that the financial statements are not showing true and fair view of the business, profits are not correctly calculated, financial procedures are not adopted properly, right? So this is how the external auditor, after getting sufficient appropriate audit evidence and with reasonable assurance, I repeat again, external auditor, he gives an independent opinion after getting reasonable assurance and after getting sufficient appropriate audit evidence. He gives an independent opinion about the financial statement that they are showing a true and fair view of the business and there is no material misstatement found in the financial statements. So this is what the role of an external auditor. They are basically appointed by the shareholders, but internal auditors are the employees of the company. They are appointed by the management and their duty is to perform the internal accounting procedures of the business. So they basically involve in the verification and watching process of the company, right? And they are hired by the management. Then public limited companies, over a certain amount, they are required to have an audit of their financial statements by an external auditor. They are required by the Companies Ordinance 1984. So I'm not going to go into detail of this. So that will be enough regarding the difference. So let's move on to the question. For the purpose of carrying out the audit, Yuan was presented with the following draft financial statement, which were prepared by the director. Revenue, cost of sales, gross profit, administration and distribution expenses are given. And profit for the year, dividend paid, dividend proposed won't come in the income statement. Dividend paid won't come in the income statement. It comes in the statement of changes in equity. Same is the case with retained earnings. Proposed dividend will not be recorded in the books of account because unless it is not yet approved in the annual general meeting by the shareholders, right? So that is a non-adjusting event. IS-10 says that proposed dividend is a non-adjusting event because it is an indicative of event that arose after the balance sheet date. So that's why that will not be recorded and given as a footnote under the balance sheet. Non-current assets are given freehold property, machinery and equipment, goodwill. Now it is written goodwill over here. Just imagine, that in the draft statement of financial position, we used to record goodwill. Yes, we used to record goodwill, but that is purchased goodwill. Just remember the business purchase topic. We have gone for the calculation of goodwill. From the assets taken over, we used to subtract the liabilities taken over, and net assets are compared with the to get the amount of goodwill that will be recorded. That is a purchase goodwill. But inherent goodwill, existing goodwill will not be recorded in the books. We know that. Current assets, inventory, trade receivable, and cash equivalent. Ordinary share revaluation reserve is given, retained earnings, trade payable, and dividend payable is not given, which should not be recorded because only paid dividend will be recorded in the books. No dividend payable will be recorded in the accounting terms. Director of Z Limited provided Yuan with the following. At 31st December, the director proposed a final dividend of 30,000. This had been included in the draft financial statement. As discussed earlier, we will not record this. The company purchased a machine in 2016 for 1,50,000 to printing graphics on the products requested by the customers. The machine had been depreciated by 20% using the straight line method. The demand for printing services is expected to decrease in the future. The director suggests that the new machine should be depreciated at 30% by using the reducing balance method. This had not yet been actioned. Fourth point is Z Limited share capital and revaluation reserve from freehold property on 1st January amounting to 1 lakh and 1 lakh respectively. A professional valuer suggests that the goodwill of the company would be 2 lakh. This amount had been included in the non-current asset and the revaluation reserve. Inventory valued at cost 44,500 had been included in the draft financial statement. Further information was available. Recommend how information 1, 3, 5, and 6 should be treated in the financial statements. 8 number. So let's talk about number 1 first. Number 1 is 1, 3, 5, and 6. Okay, we'll go for all of them. One is that 31st December, the director proposed a final dividend of 30,000. This had not been included in the draft financial statement. According to IS 10, it is a non-adjusting event. It should not be recorded in the books because it's a non-adjusting event. Why? Because it is just proposed. It is not yet approved in the annual general meeting by the shareholders. Right? So this is the event which occurs, which is an indicative of event which arose after the balance sheet date, after the statement of financial position date. So it is written as a footnote and as a non-adjusting event. Number 3, the demand for printing services is expected to decrease in the future. The director suggests that the new machine should be depreciated at 30% by using the reducing balance method. So IS 16 talks about the property, plant, and equipment. We have discussed that in depreciation. We have clearly understand the concept of IS 16, property, plant, and equipment. That is about non-current asset. They are supposed to be, their life, their cost is going to spread over the life of the asset. We have discussed that, which is known as depreciation. So, but here, the depreciation method is going to change. We know that it is against the consistency concept, but to give a more realistic value of the non-current asset, we used to adopt this change because of the reason that the printing service is expected to decrease in the future. It means that the use of the machine is going to decrease. So when the use of the machine is going to decrease, then it means that it will become obsolete. When it becomes obsolete, so that's why we are changing the method, because the value of that particular asset, the benefit we are receiving, is going to decrease in the future. Cost and benefit analysis. Because of the benefit, the depreciation is basically related with the benefit received by the cost of that asset over the life of the asset. So that's why we have changed the method from 20% to 30% according to IS 16, that there should be more depreciation through reducing balance method rather than straight line method, because the machine is decreasing its value more, right, in the early years and less in the later years, because the demand has been decreased. So that is the reason that we are using this. Then 1.5, professional valuer suggests that the goodwill of the company would be 2 lakh. That is intangible asset IS 38. Intangible asset IS 38. IS 38 talks about goodwill, patents, copyrights, those intangible non-current assets which cannot be touched. They are supposed to be amortized over 20 years. Known as depreciation, you might say that. Amortized over 20 years, right? But the goodwill, only the purchase goodwill is supposed to be recorded in the books of account. So this is basically the inherent goodwill. The existing goodwill which is created by the company, that is not going to be recorded in the books of account because it is against the two counting concepts, money measurement and prudence. And we have discussed in past also, in partnership changes also. So the goodwill which we have been recorded, which has been recorded in the books, we will not record it in the books, and it will not also be subtracted from the revaluation reserve. Inventory, IS2 talks about inventory, which says inventory is valued at cost or NRV, whichever is less. And what is NRV? NRV is the market price, selling price minus cost to sell, right? So this is estimated selling price. Cost to sell is not given, otherwise I would have subtracted it. And the purchase price, the cost price is also given. So let's take the difference of the two, and the inventory according to IS2 will be recorded at cost or NRV, whichever is the lesser amount, according to the each category of inventory. So we will discuss about the each category of inventory, and then we will go for the we will take the lesser amount out of those categories. So category A, cost price is 24,200, selling price is 33,800. We will take 24,200, which is less. Then 15,100, 24,000, less one is 15,100. Then 52,000 and 4,100. Here selling price is less than the purchase price. So we will take 4,100 rather than the 5,200. You have to sum it up. Yes, thank you. 43,400 is the total. Oh, sorry. 43,400 is the total inventory. And inventory valued at cost is 44,400. And that will has been included in the draft financial statement. So that is wrong. It should be 43,400. It means the inventory is valued more than then it should be recorded. So the difference will be subtracted from the closing inventory and will also reduce the profit, because the entry will be here cost of sales debit and closing inventory is going to be credit. What is the amount? If you can tell me the difference. 44,500 minus 43,400. That is going to be 1,100. Okay. So that is will be the entry. So because cost of sale is increasing and closing inventory is decreasing, so we have to subtract it from the retained earnings, and it will also be subtracted in the balance sheet current asset section from the closing inventory. So let's move forward. Calculate the revised profit for the year ended after taking into account your recommendation in B. So recommendation in B, whatever you have done, you are supposed to go for the revised profit. So let's go for the revised profit. But we have to see the profit for the year first, that where it is. So the profit for the year is 99,800. Right here, rather I will write revised profit, that is 99,800, right? And if you just look at the question, we have to adjust this cost of sales. So we will subtract minus 1,100, and then depreciation. There is a point of depreciation over here also, right? What we will do with that we have recorded depreciation 1,50,000 into 20%, that will come 30,000. But now we should charge depreciation according to reducing balance method, and that should be 1,50,000 into 30%. So that will come how much? Yes, that will come 45,000. The depreciation has been charged 15,000 less than the actual amount, so minus 15,000, and then we will get the revised profit, right? So what is going to be the revised profit? If you can just let me know that about the what is going to be our revised profit, you can easily get the answer. G. So how much is the answer? That is 83,700. So I will write here 83,700 profit for the year. Now, the next part is this, that we are supposed to prepare a statement of changes in equity for the year ended, and we have to prepare the redraft the statement of financial position at 31st December 2016. So let's prepare the statement of changes in equity first. Statement of equity. I will start from ordinary share capital. Then we have, let me see the heads actually. Ordinary share capital, revaluation reserve. I think share premium will be there also. So write share premium. Then revaluation reserve. Remember this, that a revaluation reserve will be used, and then retained earnings. When there is going to be increase in the price of non-current asset, there will be a revaluation increase, and there will be revaluation downward also for a non-current asset, for which we will use first of all share premium account, and then we will use retained earnings for revaluation downward. Okay, so ordinary share is basically 10 lakh. If you just look at the question, it is written over here that, okay, ordinary share capital is the same, which is 10 lakh. I will write balance over here. Share premium, we don't have a share premium. Revaluation reserve. So if you just look at the question, the revaluation reserve given in the question is 3 lakh, and that is wrong. Why? Because we have treated goodwill also, which should not be recorded in the books of account. The goodwill will not be shown in the books of account, and it will also be subtracted from the revaluation reserve 3 lakh. So the revaluation reserve is going to be only 1 lakh. And retained earnings will be adjusted accordingly, that retained earnings are given 144,400 over here. But if you just look at the income statement, we have been given profit for the year. Retained earning at the start is given on 1st January, which is 94,600. We will start our statement of changes in equity from 94,600. Right? Now I will add profit in the retained earnings column. Profit is 83,700. Dividend paid will be subtracted from here. Because dividend paid will come over here, not in the income statement. And paid will come only, proposed won't come anywhere else. So that is going to be 20,000 subtracted from here. And now I'm going to prepare the, go for the end of this statement of changes in equity. If the shares are issued at a premium, then we have to write the premium separately. The premium will be written separately, right? And share capital will be written with its face value. What will be the retained earnings at the end? If you can tell me. 94600 plus 80,000 minus 20,000. What is going to be the retained earnings at the end? G. So 94,600 plus 83,700 plus 83,700 minus 20,000. That is 158300. So 158300 is the retained earnings. And now I'm going to prepare the statement of financial position. Okay, 159300. is the total retained earnings. Okay. So 1100 we have done already. Okay. So we have done with that. The answer is going to be 158300. Now we are going to supposed to prepare the balance sheet, the statement of financial position regarding this particular question. So let's prepare that statement financial position. And definitely, I want obviously I want Fareed to help me out. Inshallah, you will be able to tell me that what are the values. We have already discussed that the all the way adjustments we have done regarding this question. So this is a full-fledged question of the IS. Yes, it has come in the paper and we are supposed to do it in the same manner. So we'll start from non-current assets. Goodwill won't come in non-current asset. If you just look at the question, factory hold property is given 7 lakh. I will write it in the same as it is. Factory property 7 lakh. Then there is going to be machine and equipment. Right here, I have to go for some adjustment. That is 457,400. And the depreciation we have done, I think we have to subtract 15,000 from 457,500, right? Because that depreciation has been done. So we have to subtract it. So what is the amount? 457,500, 457,400, sorry, minus 15,000. Why, sir? Because the depreciation we have had been depreciated by 20% with the straight line method, but because of the decrease in demand in the printing service, it should have been depreciated by 30%. We have to subtract 15,000 more, right? So what is the amount? The amount will be 442,400. Thank you. 442,400. Next is going to be the value of goodwill. It will not come because goodwill is a intangible non-current asset. Total 111,142,400. Thank you. So the total I'm going to write is 1142400. That is for non-current assets. 1142400. Then comes the current assets. Current asset, we will write first the closing inventory. Closing inventory, I'm going to write the one which has been discussed already, that we have to subtract 1100 from the closing inventory. And the amount, it will not be 44,500. It will be 43,400. Then I'm going to write the trade receivable. If it is given in the question, let me see. Trade receivable 74,800 and cash equivalent 36,000. So that will remain the same. Trade receivable 74,600 and cash equivalent is 36,800. Total is going to be 74,800. Sorry. So 74,800 and 36,000, right? 74,800 and 36,000. So the total, what is the total of current assets? Yes. So the total of current assets. Yes, I have written. So the total of current assets will be 154200, and total assets we will calculate by getting the total of the non-current assets and total of the current assets. We'll get the total assets. Then comes the equity and liability section of the balance sheet. Equity includes, first of all, the ordinary share capital. Then there is going to be a revaluation reserve. General reserve used to come also, but I think it is not given over here. Same is the case with the premium, share premium. It is also not given in the question. 129,660 will be the total assets. 129,660. So ordinary share capital is going to be 10 lakh. You just need to write the figures from statement of changes in equity as it is. That would be quite easy for us. 158,300, and the total will be having the total equity. Then I'm going to write the non-current liabilities, maybe debenture, and then current liabilities, which might not given in debentures. Let me check. So if you just see that the equity current liabilities, trade payable 38,300 is given only. There is no going to be debentures or any other liability is not given, only trade payable. Dividend payable will not come. Dividend payable will not come because it is a non-resting event as discussed with you. So it won't be the part of the current liabilities. That is going to be 1258300. ज़्यादा नहीं आ रहा. Let's see. We go for the total. That is going to be the total liabilities and equity. We'll get the answer. So this is how the IS has been discussed, or that used to come in the paper also. And we have to solve it in the same way. So they are quite not an easy task to do that, because not only the IS have been asked to solve, they used to give us IS along with the adjustments we need to require in the financial statements. The profit we need to correct, and we have to correct the balance sheet also, to revise the balance sheet also. So that is the question we have done regarding this February March 1732. So this is one of the easiest comprehensive question of IAS. From tomorrow onwards, we'll be finding the difficult ones also. So there is a concept of IAS 8, and that is regarding the accounting policies. IAS 8 is a part of the course, and that is regarding the accounting policies. And accounting policy basically state accounting policies and accounting estimate and errors. It states that if there is an adjustment, you have to make the adjustment retrospectively. You have to adjust the financial statements retrospectively and prospectively. What does it mean? It means that if some error has been committed and you have found the error in the next year, then you have to adjust the current year financial statements also and the previous year financial statements also. Means you have to give an effect of that error in the current year and in the previous year. This is known as retrospective effect. So now this particular concept is coming too much in the exams. So we are getting this concept coming again and again in the exams. So this is how we have completed this question of International Accounting Standard for today's class. And this has come in February, March 1732. And I discussed with you about the adjustments we have made for this particular question, and whatever we used to go for it. We have redraft the financial statements, and tomorrow we are going to solve this next question, obviously. October, November 22 and 31. We'll be doing this question in the next class. Thank you very much. Allah Hafiz.